Hello? Can people from the back row show me? They hear? Yeah, thank you. Hi to my family on Zoom. Uh, my name is Ewelina. I work at Bitpanda on ESG topics. And I'm really happy so many of you stayed until almost the very end. I appreciate it loads. What I plan to do today is to talk a little bit about ESG, and you heard this acronym coming quite some time today. So we will unpack it and look at practicalities. So what I want you to get out of the session, one, is that you will know how ESG evolved from the global agreements to the financial force it is today. Two, we will look at practical examples of how companies respond to ESG expectations. And three, I hope to show you that ESG can also be the driver of a long-term value. But before we look at the now, let's just rewind a little bit. This cartoon, I think, sums up the tensions behind corporate responsibility. When we look back at the 90s, 50s, Howard Bowen, who coined the term corporate social responsibility, argued that corporates should not only think about the profit, but they also had responsibilities towards the society, so us. However, for the most of the 20th century, this mindset took a backseat in favor of the shareholder-first mindset. Yes, that drove growth. However, it also had several consequences: environmental, economic, and social. So how come today I'm mentioning corporate strategy, ESG, in one sentence? We will have a look at key events that actually drove this discussion forward. ESG didn't just pop up as a trend. It didn't just come as a reporting tool. It's a result of decades-long work on environment changes, on climate changes, and on sustainable development. In 1992, 154 countries signed the United Nations Framework Convention on Climate Change. In shorter form, it's known today as COP. And this was for the very first time when collectively everyone agreed that emissions is the problem of everyone. And then in 1997, the Kyoto Protocol. This was the time when countries actually signed an agreement. Yes, we will decrease the emissions. 2004, UN pushes it forward. They released a framework, ESG framework, that showed companies how to incorporate sustainability into the operation beyond just philanthropy. And then 2015, Paris Agreement. We agreed to limit the global warming to 1.5 degrees. And with ambition came accountability. Organizations such as Science Based Targets Initiative showed us how to emulate those targets to corporates and set emission reduction targets that are in line with science. This was for the very first time when we started to see that voluntary, often fluffy, non-comparable commitments actually turned into measurable targets that are reported on transparently. So you might be still wondering why a 2015 climate agreement affects my corporate loan today. I will get to that, I promise. When we talk about ESG, we often think about it, it's something we can opt in, it's optional, we don't really have to think about it. But with these three prominent examples, I would like to show you what happens if you don't think about it. So first, we have the Deepwater Horizon oil spill, one of the largest environmental disasters. It cost BP more than $60 billion in cleanup, in lawsuit, in fines. And at its core, it was a lack of environmental risk management. We have the Bangladesh factory collapse. It killed 1,100 garment workers. Global brands were sourcing from factories with known safety risk violations. As a result, everyone started pushing for transparency on global supply chains. And lastly, Volkswagen scandal, cheating on emission tests. It led to 30 billion in lost value, lost trust, and in fines, obviously. So now that we looked at these specific examples, I hope it's much easier to understand what ESG stands for. E for environmental. So what happens if environmental risks are not managed? S for social, when workers' rights and safety are ignored. And G for governance, when the oversight and unethical decisions are day-to-day. ESG is a framework that allows us to evaluate organizations on how they do business and how responsibly they do it. We look at environmental impact, labor rights, ethics. And in the financial world, this is how investors today screen companies for long-term risk mitigation and their operational resilience. Practicalities, let's get to that. So ESG is actually influencing how companies operate and compete on the market today. It changes the way how they access capital, it changes the way how they screen suppliers, but it also prepares them for long-term growth with ever-changing regulatory landscape. I will only focus on the first two, and we can leave the regulation for another day. Sustainable finance. When we talk about this, we talk about how investors move the money towards companies that operate more responsibly. We have, for example, a bank that will tie its loans interest rates to ESG performance. That's a financial incentive. We have an investor who will choose a renewable energy project instead of fossil fuels. That's long-term thinking, risk mitigation. And then we have a company issuing a green bond, tying climate action with access to capital to finance clean transportation. So why would banks actually finance or look into ESG KPIs more and offer better terms for a loan? It's because they see it as a proxy for risk mitigation and long-term value creation. Great example, Philips, it was one of the first of a kind. ING partnered with them on a 1 billion revolving credit facility. What it meant, here's the twist, if their ESG rating increased, interest rates went down. ESG rating dropped, interest rates go up. Fun fact, they didn't have to spend the money only on green projects. They could spend it more broadly on anything. But the sustainability performance was driving the cost of the loan. Heads up, it doesn't affect only corporates. Today's startups are also on the lens, let's put it this way. Venture capitals are also incorporating ESG into how they operate. It's because of the regulation, investor requirements, but also talent wants it. So under the Sustainable Finance Disclosure Regulation, venture capitals have to report on their portfolio companies and how they manage key ESG aspects, whether it's water usage, supply chain, diversity. And how does it translate in practice? ESG clauses in term sheets. So at the moment the investment kicks in, your startup, for example, will have 12 months to fulfill 4 out of 20 requirements. That could be measure your emissions, look at your supply chain, do you have diversity metrics for your leadership? Some investors go as far as they ask at the exit time for a founder's pledge. I will explain what it is, but the idea is that investors want to incorporate and emphasize the ESG impact throughout the whole investment cycle. Founders Pledge means that if founders get really rich, they have to donate to charities. What's often also overlooked is the supply chains, and I mentioned that word a few times already. This is where companies have a lot of blind spots, most of risks, most of the unknowns. So it is becoming more and more important that companies don't only look inward, but they also look outside. CDP, Carbon Disclosure Project, estimates that the emission from supply chain are 26 times higher than those from their own operations. So imagine how many more risks, ESG risks, are out there, such as corruption, abusing labor rights, and safety. So companies now don't only report on themselves, but they also report on their supply chain. And it means that if you're a supplier, your ESG data will mean whether you make it to the supply chain of your customer or not. It means that some companies look into ESG ratings before they even engage in a procurement process, or they evaluate diversity and human rights practices in the company. So again, if you don't meet the ESG requirements, you are at risk of losing business. ESG due diligence becomes a daily practice for many, especially larger organizations, in their procurement processes. It's no longer looking just at price and quality, it's also looking into your ESG KPIs. Example, your biggest customer calls you up and sends you a questionnaire. Do you have environmental policy? Do you measure your emissions? And if not, when will you start? Do you have a science-based target? No? Will you have it by 2030? I know it sounds quite extreme, but it is actually true. We have an example of Salesforce. Salesforce actually set a science-based target. And one of their targets is focused on decarbonizing their supply chain, which means they committed to having 60% of their suppliers to have science-based target by 2024. Fun fact, they didn't meet that goal. Only 25% of their suppliers actually set the targets, but they're revising it this year. It doesn't matter. It's a proof that ESG is becoming relevant for supply chain. And two, it's not focused on just soft things like, do you have a policy? It's actually driven by metrics today. A totally different example, but equally strategic, is AstraZeneca, who, by the way, this week was named one of the best performing sustainable companies in Europe by the Financial Times. They have incorporated their company values into the whole procurement process. And they look into health equity, environment, and social development. So what they do is they work with EcoVadis, which is one of the ESG rating companies. And they screen their suppliers for environmental topics and other ESG KPIs, but also they look to work with diverse and minority-driven businesses, for example. And through that, they fulfill their commitment to health equity, for example. Cool. We looked at a lot of practical, or a few practical examples to set the stage, but the question remains, does it work? Loads of opinions on ESG, and I think we can also, how many people in this room, how many opinions? As with any complex topics, the truth is always in the middle. Some say it's a distraction. Others say that it's a driver of a long-term value. We have a study here from McKinsey. They look at 2,000 companies, and ESG KPIs and metrics and the initiatives that the companies did boosted the equity 63% of the cases. It's because those companies scored more deals, it's because they got more grants or loans, and their employees were motivated. Just a few reasons listed here. But on the other hand, when we look at investors, they struggle implementing proper investing strategies into their portfolios because there's so many ESG ratings and there's so many different accreditations that it's also hard to compare the data. So the pricing of ESG stocks, bonds, ETFs, you name it, doesn't happen singularly. It's based on the investor preference, it's based on timing, and it's also based on market sentiment. And as we know today, it's also not so clear. So the bottom line is, if ESG is done well, it will drive long-term value. So what companies can do about it? Boiling it down to two pragmatic questions. One is, which sustainability matter will be the best for your bottom line? And two, where is your company doing the most harm and what you can do about it? ESG doesn't happen in the same way for everyone. It depends on your business model, your geography, whether you're a startup, corporate, you name it. Every company has to do it in their own way that works best for their business. And as John Elkington, who actually coined the triple bottom line model, he later questioned his model. He said that it was used purely as an accounting tool and not a way to rethink how the business is made. He still stands by its core, meaning that today, success means that you tie purpose with results. So, the three things I hope that you're getting out of this very quick, tight ship, high-level content I shared with you. ESG is not something that just popped up randomly. It's the work of global, decades-long collaboration on climate change and sustainable development. And today, it changes how companies compete and operate on the market. Companies don't only passively respond to the requirements, they actually incorporate them into how they operate, how they manage risk, how they screen suppliers. And lastly, if they do it well, they see the results. And with that, thank you so much.